If you woke up in 2026 with $0 invested, no stocks, no assets, maybe a little debt and a job that barely covers your bills, most people would panic. Headlines would scream about artificial intelligence replacing jobs, housing prices that look like phone numbers, and markets that feel unstable. And this is exactly where most people freeze. They assume the game is rigged, so they never even pick up the controller. But here's the truth: most people never hear. Starting from zero in 2026 is not a disadvantage. It's one of the cleanest entry points we've seen in over a decade, if you ignore noise and follow structure. Today I'm going to show you the exact system I would use if I had to rebuild from absolute zero, based on compounding math, market cycles, behavioral finance, and human psychology. This is not a get-rich-by-Friday plan. This is the blueprint to your first $100,000, then your first million, built to survive recessions, job disruption, emotional mistakes, and bad timing. And before we begin, let's make a deal. I'm not selling a course. I'm not pitching magic investments. The only cost here is attention. If you want to treat this channel like peer review for your finances, subscribe and lock in, because this system only works if you respect the order of operations. Here's the first mistake almost everyone makes when starting from zero. They ask what stock to buy. That's the wrong question. The real enemy isn't lack of opportunity, it's negative compounding. And negative compounding usually wears a friendly disguise called monthly payments. Credit cards, buy now, pay later, high-interest consumer debt. People think they can out-invest bad habits. They look at a 20% credit card and say, by my see, the market average is 10%, I'll catch up later. That is mathematically impossible. That's like filling a bucket with a hole in the bottom. If you have $5,000 in consumer debt at 24% interest, you are not starting at zero. You are starting in a financial hole. Paying off that debt is not boring. It is a guaranteed 24% return. There is no legal stock market strategy that can offer that without extreme risk. This is why Phase 1 is not investing. Phase 1 is becoming a debt destroyer. Not slowly, not casually, aggressively. Avalanche method. Highest interest rate first, minimum payments on the rest. Every spare dollar attacks the most expensive debt. Sell what you don't use. Cancel what doesn't protect survival. Treat this phase like your financial house is on fire, because mathematically, it is. And here's the emotional cost most people underestimate. Debt doesn't just drain money, it drains courage. When you owe money, you negotiate weaker at work. You avoid career risks. You stay in jobs you hate. You don't move cities for opportunity. You don't ask for raises because you can't afford instability. Clearing debt isn't just financial relief, it's psychological freedom. It gives you leverage over your own life. Now, once the debt is gone, here's the next trap that wipes out beginners. Most people immediately rush into stocks. They download an app, buy the S&P 500, feel smart. Then life happens. The car breaks down, medical bills arrive, job disruption hits, and suddenly the market is down 20% at the same time they need cash. They are forced to sell at the worst possible moment. That single mistake permanently damages compounding. This is why Phase 2 is not investing either. Phase 2 is building a cash fortress. Not because cash makes you rich, but because cash keeps you alive in bad months. This is your sleep at night fund. 3 to 6 months of bare survival expenses. Rent, food, utilities, basic transportation, nothing fancy. This money is boring by design. High-yield savings or money market funds. Liquid, accessible, stable. People hate this step because it feels slow. It doesn't spike dopamine. It doesn't look impressive. But mathematically, this buffer protects your portfolio from forced selling, which academic research consistently identifies as one of the biggest drivers of long-term underperformance. Let me show you why. Two investors enter a market correction. Investor A has no cash buffer. Investor B has $10,000 in emergency savings. The market drops 20%. Both lose their jobs. Investor A sells stocks at the bottom to survive. Loss locked forever. Investor B uses the cash buffer, waits for recovery, keeps compounding intact. Over decades, this single difference separates survivors from winners. And psychologically, something powerful happens when you have this buffer. You stop making money decisions from panic. You negotiate differently. You stop reacting emotionally to red charts. You gain what most people never experience: calm leverage. Now, and only now, you are ready to invest. And this is where people expect complexity. They think diversification means buying everything: crypto, gold, AI stocks, international funds, random hype assets. But early-stage portfolios don't need complexity. They need reliability. Concentration builds wealth. Diversification preserves it later. The temptation in 2026 will be AI-powered stock-picking apps promising alpha. But data does not care about hype. According to S&P Dow Jones SPIVA scorecards, over 90% of professional fund managers underperform their benchmark over 15-year periods. These are people with Bloomberg terminals, research teams, and institutional resources. If they can't consistently beat the index, your phone app won't either. The winning strategy isn't finding needles, it's buying the haystack. Broad market low-cost index funds historically average close to 10% annually, before inflation over long time horizons. That's boring. And boring is exactly what makes you rich. Because boring compounds. Excitement usually signals gambling. Here's the structure. Core and satellite. 90% of your investable money goes into automated low-cost index funds. Total market exposure. Broad diversification. Long-term holding. You never touch it. The remaining 10% is your sandbox. If you want crypto, individual stocks, AI hype plays, this is where they live. If it goes to zero, your future is safe. If it moons, great. You scratch the dopamine itch without blowing up the plan, but even perfect investing can be sabotaged by one invisible leak: taxes. Most beginners invest inside regular brokerage accounts because it's easy, but ease is expensive. Every sale triggers capital gains. Every dividend gets taxed. Over decades, this tax drag quietly steals massive portions of your wealth. Smart investors don't just think about returns, they think about location. Where your money lives matters. This is where the tax shield comes in. Governments literally reward long-term investing through tax-advantaged accounts. Ignoring them is voluntary wealth destruction. Step 1. Employer 401k match. That is free money, a 100% immediate return. Nothing beats that. Step 2. Roth IRA. Tax-free growth. Withdrawals later with no capital gains. Step 3. HSA if available. Triple tax advantage according to IRS classification. Step 4. Fill remaining retirement buckets. Only after all tax shelters are used should taxable accounts come into play. Let's make this real. Invest $10,000. It grows to $100,000. In a taxable account, you might lose $15,000 to $20,000 in taxes. In a Roth, you keep all of it. Same investment, different outcome. Not because of better stock picking, but because of structure. Now we reach the part people love to ignore: income. You can only cut expenses so far. There is a floor to spending, but there is no ceiling on earning. The internet loves the latte myth, the idea that skipping coffee makes you rich. It doesn't. Budgeting keeps you alive. Income growth accelerates timelines. Defense prevents loss. Offense creates breakthroughs. Instead of obsessing over saving $5, shift focus to earning $5,000 more per year. A 10% raise on your primary income compounds across future raises, retirement contributions, employer matches, and career leverage. Compare that to gig work. Driving extra hours gives linear income. Stop driving, money stops. Learning a high-leverage skill compounds across decades. Sales, data analysis, automation, project management, communication. The uncomfortable truth is this: upgrading skills is harder than side hustles. It requires being bad at something temporarily. It requires humility. It requires delayed gratification. That's why most people avoid it. Comfort zones kill financial momentum. So here's the skill audit. Look at your current job. Ask yourself what one skill would make you undeniable in this role or industry. Then dedicate 1 hour per day. Not scrolling, not doom news, one focused hour. In 6 months, leverage that skill for promotion, raise, or job upgrade. That income bump makes every investing step 10 times more powerful. Now let's recap the full system. If you start from zero in 2026, Step 1. Destroy high-interest debt using avalanche method, guaranteed return. Step 2. Build 3 to 6 months emergency cash fortress, stability layer. Step 3. Automate investing into tax-advantaged accounts using boring index funds. Step 4. Protect the plan with a core satellite structure. Step 5. Aggressively upgrade your income engine through skills. This isn't sexy. It isn't viral hype. It won't make you rich overnight. But I've run these numbers across different market environments, interest rate cycles, and behavioral models. This structure wins long-term because it aligns with math and human behavior. And here's the emotional truth I want you to remember. I wasn't bad with money. I was unstructured. When I finally built systems instead of relying on motivation, everything changed. My account balance looked smaller at first. My freedom felt bigger. That's when I realized wealth isn't loud. It doesn't show up in cars. It shows up in calm. So here's your choice. You can keep reacting to headlines and hoping markets save you. Or you can build a structure that works while you sleep. Comment 0 if you're starting from nothing. Comment stack if you're building your system now. I read them. And subscribe if you want calm, honest money strategy without hype. Because chasing money keeps you stressed. Building systems sets you free. Thanks for watching.